Okay, hi everyone, guys. Good morning.
Good morning, sir. How are you?
Good morning, sir.
All right, so our next topic is fixed income securities. All right. Now, guys, when we talked about uh, equities, in that you don't have any fixed income, right? Uh, Equity is a financial instrument, financial product. And similarly, fixed income is a different financial product. They have different risk and return characteristics. And as the name suggests here, fixed income. So these are the type of instruments which provide you returns in the form of regular or fixed interest payments and repayments of principal amount at the time of maturity. Okay, so guys, today we are going to talk about bonds. We are going to talk about some of the major fixed income instruments, that is bonds, mortgage-backed securities, and guys,
Your voice is not clear.
okay, is it fine now?
Yes, sir.
Uh, See, guys, among these instruments, bonds have the biggest market. Hence, we are going to spend most of our time discussing about bonds. Okay. Uh, any idea about what is the globally traded stock market value?
So repeat the question, sir.
What is the globally traded market value of stocks? As it is $70 trillion. Whereas if you talk about the bonds, that is an even bigger market than stocks. Okay. So it has a value of around 92 trillion. Okay. So although we are not aware, or we don't have so much knowledge, or we don't hear about the bonds so much, but it is a huge market, and it is a very important product for an IB also, along with equities. Okay, it's a very big market. So very important topic. Let's start with the bonds. So now, what are bonds? Who would issue them and why?
So government would issue them at a fixed rate, and the companies also issue the bonds.
Okay. See, guys, we talk about bonds, or you talk about equities, whoever needs funds can issue them. Okay. And these two are our capital market instruments. Does anybody remember what is a capital market? Does anybody remember what is a capital market, guys?
Where securities are issued in order to raise capital in terms of equity and debt.
Yeah. So guys, if somebody wants to raise money for more than 1 year, they can use the capital market instruments. Okay, both of these are capital market instruments. So let's say government wants to raise funds for more than 1 year, or any company wants to raise funds for the more than 1 year. Banks wants to raise, or any financial institutions wants to raise funds for more than 1 year. How can they do it? By using the capital market instruments such as bonds and equities. Okay, so guys, this is the similarity between bonds and equities, that they both are capital market instruments. They both are issued by the government or the company or the banks to raise capital for more than one. Okay. What is the timeline for an equity, guys?
Stock market timing, sir.
No, no. What is the timeline in terms of for how long do you raise money if you issue the equities? If you talk about common shares, infinite, right? You have issued the shares, you have got the money for your lifetime, right?
Yes, sir.
Yeah. But guys, if you issue bonds, you redeem them. Okay. So they have a tenure, they have a fixed life, unlike equities. Okay. There is one perpetual bond also that has an infinite life, but apart from that, every bond will have a finite life. It can be 3 years, it can be 5 years, 10 years, 20 years, that's fine. But it will have a life of more than 1 year, and it would be redeemed back by the company, only exception being perpetual bonds. Okay, so if you want to raise funds for lifetime, they would issue the equities, but they have to dilute the ownership. But in case they want to raise funds for next 5-10 years, that these entities can issue bonds for 5-10 years, and they don't need to dilute the ownership. Okay. Usually, you will find infrastructure companies or government entities raising a lot of funds through bonds. Okay? For example, L&T Finance, Muthoot Finance, National Highway Authority of India, IRB Infra. These kind of companies you will see issue bonds on a regular basis to raise funds without diluting the ownership. Okay. So guys, simply how it works is that the borrower would give you bonds. The lender or investor, this entity is known as issue. Now, borrower can be anyone. Okay. Similarly, investor can also be anyone. It can be an individual also. Individual cannot be the issuer, but individual can be the investor. Okay, guys, let's take an example of a bond. So a bond would have a few characteristics. There'll be a face value. There'll be a coupon rate. So whatever are the characteristics of the bond, all these things will be mentioned in the bond. It's like a document has all the. So guys, whenever the issuer is issuing the bond, he will give you a bond intention in which all the details related to the bond will be mentioned. Okay. Some of the details I have mentioned, such as face value, coupon rate, payment schedule, maturity, and other features. Let's look at an example of a very simple bond. Guys, any idea what does it mean? What it means is, let's say it is a par value bond. Okay, I'll tell you what is a par, what is a discount value, and what is a premium bond. Discuss that later on. But let's assume for now it is a par value bond. So it will be issued at $1,000. Okay. So that means if the borrower is issuing this bond, then what would happen? The borrower would get $1,000 per bond at the time of issuance. Okay. The borrower would get $1,000 per bond for every bond the borrower is issuing to the investor. So investor has to pay $1,000 for this bond. Okay. Now, guys, let me draw a timeline. We change it to 3 years.
So there is a voice problem somewhere, sir. Not clear.
What voice problem? Just a second. Okay, please check now. Is it better? Can you hear me?
Yes, sir.
Okay. What is happening here is at the time of issuance of the bond, let's talk about from the investor perspective. You invest in the bond, what would happen right now? You need to pay $1,000. Okay, I'm writing minus as we need to pay. You need to pay $1,000. 1 year later, you will get 8% coupon. Okay, so what is the amount you are going to get? 8% of $1,000, that is $80. After 2 years also, you are going to get $50. After 3 years also, you are going to get $50. And 3 years is the maturity also. So at maturity, you are going to get your face value back as well. So this is what you get. Initially, you have to pay $1,000, and what you get is 80 after 1 year, 80 after 2 years, and 1,080 after 3 years.
Sir, coupon is the interest rate, sir.
Yes. Coupon is the reward, is the return you get when you invest in a bond. Okay, so 8% coupon means 8% of face value you would get as a coupon payment every year because it is an annual payment. Okay, so guys, that's why we say it's a fixed income security. Why? Because when you invest, you know what you are going to get. Okay, unlike cash equities where you don't know what will be your returns, but here you are very sure what will be your returns. That's why the name fixed income securities. But guys, don't take it too literally. Okay, it's not. We have taken a simple example, but it may not be exactly fixed. Okay, it can be a floating rate bond also, in which the coupon amount you are going to get can vary. Okay, but still you can be sure that there'll be regular payments, and you have a rough idea about the amount of payments as well. Please note it down. If you have any doubt, let me know.
Sir, bill is also type of bond.
So difference between a bill is for less than 1 year and a bond is for more. Bill is your money market instrument, whereas bond is your we talk about government. Government issues bonds as well as bills. Okay, we call them T-bills, T-bonds. If government wants to have some funds, have some money for less than 1 year, they will issue T-bills. If they want to have money for more than 1 year, they will issue T-bonds.
So the contract is called bond indenture.
Yes, that document is known as bond indenture. The contract document is known as a bond indenture, in which all the details, all the characteristics of the bond would be mentioned.
And so if 8% is the interest rate, then what is the annual pay? $80 only.
Sorry, can you repeat your question?
What is the annual pay? $80 is the interest rate. So what is the annual pay?
This is, I mean, this tells you when would you get your refund.
Okay, sir.
Is do one thing, draw the cash flows for this one.
Sir, I missed. Can you repeat, sir? Once again?
Sorry,
Can you repeat, sir? I just missed the example of last example.
this one.
Sir, yes.
Yeah, I'm saying that try to build the cash flows like we did earlier for this bond now. It's a different bond. So try to build the cash flows yourself for this.
So done.
Okay. Guys, tell me, what are the cash flows?
$40 after first year and $40 plus $1,000 after second year.
After a year or
For the first year, after every 6 months, there will be payment of interest, $40. Similarly, for the second year also, and at the end of second year, there will be 40 plus 1,000. That is the payment of principal amount also.
guys, it's a semi-annual program. Okay, you have to. Yeah. Please note it down, guys. And if there is any doubt, let me. Now, equities are your exchange traded products. Okay. If you remember, we discussed two types of markets: exchange traded versus OTC. Right? Exchange traded is the securities traded on the stock exchange, yeah, or commodities exchange, whereas OTC is dealer. Yeah, OTC is dealer market, where two parties sit across the table and deal with each other. Okay. Now, guys, equities are exchange traded, whereas bonds are mostly OTC. Okay. Almost 90 to 95% of the bonds are OTC, but there'll be some listed bonds. Very few. Mostly the bonds would be OTC. Okay, so if you want to get some bonds, you have to go to your bank, which would be acting as a dealer. Yeah, or if a big institute wants to buy some bonds, they would go to an investment bank, and investment bank would act as a dealer. Okay, so it's an OTC traded product. There is no exchange involved for most of the bonds. Okay. Now, guys, you have to tell me, how are they different from equities? Can anybody tell me, guys, how are they different from equity? First, equity is exchange traded. They are mostly traded. Any other difference you can think of?
The ownership difference.
Very good.
Bonds.
Get ownership, and specifically what you say, you get hard ownership, right? When you buy the shares of any company. Here, you can buy as many bonds as you want. You don't get any ownership. Okay. Here you have voting rights because of the ownership. Here there are no voting rights.
So equities are riskier.
Higher risk. Good. Why do we say higher risk?
Maturity.
Why do we say higher risk?
Because the markets are uncertain in case of equity.
We don't know what is going to be our return, right? How much dividend we are going to get, what would be the capital appreciation. There is so much uncertainty, and that uncertainty is the risk, right? Usually higher returns also, guys. You would get slightly lower returns. have uncertain returns. Here you have fixed or regular returns. Certain returns. Think there are more.
Some maturity period.
Good. They have infinite life. Okay, till the company will be there, common shares will be there, but they have a fixed maturity. One more.
The transferability. Transferability.
Okay. Yeah, guys, because it is exchange traded, so you can say transferability is slightly easier. But as I said, guys, it's a OTC market, but it's a huge market. Okay, please remember what I said. I told you that it is an even bigger market than equities market, right? So if it is such a big market, would it really be difficult to find a buyer or seller?
No, sir.
No, sir.
Okay. Usually it is not, guys, and unless and until you are talking about some bond which is really not popular and you have bought that bond, in that case the liquidity will be a problem. There will be a difficulty in transferability. But in general, for let's say government securities or popular corporate bonds, this will not be a problem. Okay, but still, if you want to say, you can say that transferability is more here, liquidity is more here, and especially when we talk about liquidity, here we are talking about, let's say, large cap stocks. Okay, where there are a lot of buyers. So in that case, transferability would be more. Whereas in the bonds, it can be a challenge for the bonds which are not popular. But guys, it's something which you need to discuss. Okay, I mean, it's not black and white. I hope you got it, guys. Transferability and liquidity depends upon the type of equity, type of the share, which company's share are we talking about, type of the bond we are holding. I hope you got it, guys. Yeah. What else? Last one, please.
At the time of liquidation, bond holders are in the first preference to get the principal amount.
Very good. Okay. So at liquidation, last preference at the time of liquidation, and they get the first. Please note it down. If you have any doubt, let me know. We said that you get fixed or regular payments, but I guys want to know, are there any risks involved investing with bond? Do we face any risk or not if you invest in the bonds? Yeah?
So some risk of there with every type of bond.
What is the risk, guys? Specifically, guys, you have government bonds. Okay, these are the major bonds. Government bonds are issued by the government, and corporate bonds are issued by the companies which wants to raise money. Okay. Now, guys, think of this. If you invest in these bonds, if you buy these bonds, do you face any risk of it?
Sir, in corporate bond, we get some risk associated with it.
Yes. First is the credit risk, okay, or you call it the default risk. That that whatever coupon payments and principal repayments need to be made, the issuer may not be in a position to make the payments on time or make the payments. Okay, right? So you may not get your coupon and principal repayments on time, or you may just never get them because the issuer's financial position has deteriorated and he is not able to pay the required coupon or interest payments. That is the default risk. Okay. Next is the interest rate risk. Interest rate risk is that, let's suppose you invested in this bond, which is paying you 8% coupon rate, but interest rates in the market increased. Okay. Who influences the interest rates in the market, guys? Any idea who influences the interest rates in the market?
Sir, inflation.
RBI. Okay. RBI, they have their monetary policies in which they decide the repo rate, CRR rate, SLR rate, right? So at these things influence the interest rates. Okay, if RBI increases the rates, then banks also increase their saving deposit rates, their FD rates, the loan rates also increase, everything increases. Okay, if RBI decreases their rates, everything decreases. So RBI monitors everything, and based on that, they decide the rates which are good for the economy. Okay. Now, let's suppose you invested in the 8% coupon bond and you are getting these $40 every 6 months. Okay. Let's suppose RBI increased the rates and now it is 10%, but you are still holding this 8% coupon bond. Getting it? You are still holding this 8% coupon bond, but after you bought it, let's say 1 year down the line, you bought it and you found out that, okay, now the interest rates are 10%. So now what are the bonds are coming up in the market are offering 10%. Okay, but you are stuck with this 8% coupon rate. So what will happen? The value of such a bond would go down. Yeah. Obviously, nobody would like to buy them, so demand would be lower than the supply. So what would happen? The price, the value of the bond would go down. Okay, so if you try to sell it in between, let's say after 1 year, yeah, here if you try to sell it, you will not be able to sell it at $1,000. You might be able to sell it at $850 or $900 or $950, depending upon how much the value has decreased. Okay. So as the
can you repeat? Actually, my internet got disconnected.
You got disconnected?
Yes, yes.
Buddy, you have to, I mean, be sure before the session, okay, that everything is working fine. Anyways, I'll repeat this. What I'm saying is that let's say you invested in this 8% coupon bond, okay, for 2 years. After 1 year, the rates increase to 10%. Okay. What would happen to the value of existing bonds? The value will go down. So that's the interest rate risk. that as the interest rates in the market increase, the value of existing bond decreases. Okay. Next, you have inflation risk. Pretty much on the similar lines, you know what is inflation, right? So let's suppose you invested in these 8% coupon bonds for 2 years, but the inflation increased. Okay. So inflation is now, let's say, 9%, and you are only getting 8%. So that means you are not even able to recover your purchasing power. Yeah. Your purchasing power is decreasing by 1% because you are only getting 8% return, whereas the inflation is 9%. So whatever in real terms, you are not getting. In fact, you are losing the purchasing power. Yeah. If you adjust your returns for the inflation, you are in negative.
So we require the more required rate of return to beat the inflation.
Yeah, obviously, we want to invest in something where we are getting returns at least higher than inflation, right? So that our purchasing power does not go down. Otherwise, what is the point of investing? Yeah. Obviously, if the inflation is high, we would invest, our return expectation would be higher. We try to invest in those instruments which are offering a higher rate of return, higher than the inflation, so that we can at least maintain or increase our purchasing power with time. We do not want our purchasing power to go down with time. Okay, so we have to keep up with inflation, but here you are stuck for 2 years. Okay, I mean, you can sell the bond in between. It's in the OTC market, you can sell it. But guys, what would happen? You would not be able to sell it at $1,000. Okay, because the demand for such bonds would go down if the interest rates increase or if the inflation increases. Then nobody would like to have just the 8% coupon. Yeah. So what will happen? The value of bonds would go down. So you might have to sell at a lower price than what you paid. Okay. Are we clear with the 3 risks?
Yes,
sir.
All right.
sir, is there any liquidity risk involved in this?
Liquidity risk is pretty much the same. Okay, for example, if you want to sell it, then it can be difficult in terms of if the value or demand of the bond has really gone down, it will not be easy to convert it into cash. Okay, related to transferability. Yeah, it will be difficult to transfer if there is low liquidity, and there can be low liquidity because the demand is lower for the bonds which are offering a lower coupon rate. Okay, guys, there are many other risks also. For example, there is reinvestment risk, that at what rate you will be able to reinvest your interim cash flows. Okay, you can never be certain about what is the return you are going to get by investing this 40, 40, 40, right? So that is known as reinvestment risk. But don't go with all the risks. Okay, it's beyond our scope. Focus on these 3 risks.
So we can say that this also risk-free nominal rate.
You can also say that
Risk-free nominal rate.
risk-free nominal rate. Yeah, you can say that. What you get is not risk-free, but this is the nominal return you get. Okay, why not risk-free? Because you are facing these risks. So it's not really risk-free. In government bonds, you can say that you don't face the credit or default risk because we don't expect the government to default. So there is no credit or default risk associated with government bonds. These are very safe. But obviously there is reinvestment risk, there is interest rate risk, there is inflation risk, all these are there. This will not be. Yeah. Guys, can we go ahead?
Yes, sir.
Now there are different types of bonds. First you have on the basis of maturity. So guys, the bonds can be classified as short-term bonds, bonds which have a maturity of less than 5 years. Pretty straightforward. If you have any doubt, let me know in this. Okay, are we clear?
Yes, sir.
Then we have secured bonds versus unsecured bonds. Any idea about these guys? You must have heard this. What are secured bonds?
Secured bonds are those which are secured by some collateral.
Okay, okay. Anybody else?
So in this bond, there is some kind of security is given by who is issuing.
Yeah. So guys, secured bonds are those bonds which are backed by the assets of the company that issued them. Okay? For example, there will be specific assets mentioned which are backing the bonds. In case the company defaults on the payment of bond, those those assets can be sold off for the repayment to the bondholders. Okay, secured bonds are the bonds which are backed by the specific assets of the company, and in case the company defaults on these bonds, those assets would be sold off in the market, and whatever the money is got, that would be paid to the bondholders to recover the investment. Okay, unsecured bonds are the bonds which are not backed by any assets of the company, so you don't have the claim on the assets of the company. Okay. In which case do you think the company would need to offer a higher coupon rate? In which case do you think when the company is issuing the bonds, in which case would the company need to offer a higher coupon rate?
Unsecured.
Secured, sir.
Secured.
Unsecured, okay? Because otherwise they will not be attractive at all. To attract the investors, see, secured bonds are already attractive for the investors, right? The risk is low. Yeah. And in case of unsecured bonds, the risk is higher. Would you agree?
Yes.
Yes, sir.
Yes, sir.
So where would your return expectation would also be high?
Unsecured.
Unsecured.
Unsecured, right? So you would want a higher return before investing into unsecured bonds. Only then you will invest in the unsecured bonds if you are getting a higher return. Yeah. So the company would need to offer higher returns in case of unsecured bonds to make them attractive for the investors. I hope that's clear, guys. You tell me now, government bonds. Guys, think and then answer. Okay. Government bonds are secured bonds or unsecured bonds?
So there can be both.
Unsecured.
Yeah. See,
Secured.
no, these are unsecured bonds. There are no specific assets of the government. Okay, they will not give you their power. Okay, they will not give you the chair. So there are no specific assets which are backing the government bonds. Okay, uh, the government does not have assets as such. It's the people's money which they use, right? So basically, these are unsecured bonds, but would they be safe or not?
Safe, sir.
Safe, sir.
Okay, but unsecured bonds, we said, are riskier. They are less safe than secured bonds. Why are you saying these would be safe?
Because they are
Default
backed by the
risk.
government.
Yeah. Default risk will be very minimal.
Yeah. So, guys, these are considered to be the safest unsecured bonds. So these are considered to be the safest unsecured bonds. Please remember this, that they are unsecured, but still they are considered to be safe because the government has a power which no company has. The government can print money. Yeah. So if somebody has the power to print money, would they ever default? They can always make the payment, right? So that's why we call them safest unsecured bonds, although there are no specific assets which are backing these bonds, but we still call them very safe because we don't expect the government to default because they have the power to print money. So why would they default? Yeah, they can always print money and make the required payments. Okay. Is then you have corporate bonds versus government bonds. What is the difference here? What do you think, guys? Government bonds versus corporate?
Risk factor.
Yeah. So first of all, the issuer is different. Here, these bonds are issued by the government, and these are the bonds which are issued by the companies. Yeah. We don't expect the government to default, so the risk would be lower here. The company can default, so the risk would be higher. Yeah. In which case you will get a lower return and higher return?
Government lower and corporate one will be higher.
Absolutely, guys. It's very simple. Let's say if they are offering you 5% coupon rate, guys, and just taking a random figure, okay, don't take it literally. Giving an example that let's say they are offering you 5% return, then what would government bond be offering you? You make a guess. Make a guess, guys. How much would the government bond be offering you?
3%.
Higher return, buddy. Only then you will invest, no? If they are offering
Yes, sir.
3% return, you would always invest in government bond, right? Risk भी कम है, return ज़्यादा है फिर तो, right? So lower risk, lower return, higher risk, higher return. Okay, if there is higher risk, they need to compensate it by paying a higher coupon. I hope you are clear, guys. Okay, government bonds have got different names, guys. For example, um, they are known as munis in US. Okay, munis are issued by the municipal bodies. They are known as T-bond, treasury bonds in US. They are known as G-secs in India. They are known as gilts in UK, bonds in Germany. Okay, and usually you will see that the government bonds are tax free. So whatever returns you get on them are tax free, and this is done to attract the investors so that the government never faces any problem in raising money through bonds. Are we clear, guys?
Yes, sir. Sir, can you write to some example of secured versus unsecured bonds?
Secured versus unsecured.
Some examples.
Guys, I don't have a specific example, but it's very simple. Okay, the company, when issuing any bond, would mention whether it is secured or not. Okay, so they would mention it is a secured bond or unsecured. And if it is a secured bond, they would mention the assets which are backing the bonds. Okay.
Sir, yesterday some part of cash equity are incomplete. So,
Oh, yeah. Thanks for reminding me, buddy. Um, let's try to finish this and then we'll try to cover that. Okay. Please keep that in mind. Okay? Then we have other varieties also, guys. We have zero coupon bond. As the name suggests, there is no coupon. Okay, so there is no intermediate coupon payments, but what you get is they would be issued at discount and redeemed at par. For example, this. Okay. Can you tell me the cash flows for this bond, guys?
No cash flow, only the difference will be the profit, I think.
How much do you need to pay to buy this bond?
sir, starting will
800.
be
800.
800,
800 rupees.
800, and after
Very good.
maturity we get 1000 rupees.
Absolutely. Absolutely. Good, guys. So what would happen? You need to pay 800 and you get 0. So there is no interim coupon payments, but they are issued at a discount and redeemed at par. And whatever you get is like your returns. Okay, you are getting a return of 200 in 3 years. Okay, this is considered as the interest only, guys, but there are no coupon payments. Okay, it's like you have got an interest of 200 rupees here. Okay, in your ITR calculation, this would be as an interest income. Okay. Then you have convertible bonds. As the name suggests, again, investor. Okay, please listen carefully. Investor has the right to convert these bonds into equity during the life of the bond. Okay, investor has the right to convert these bonds into equity, common shares during the life of the bond. So guys, let's look at this example. Can you please understand this?
Sir, if we redeem into equity share, we get 20 shares.
So here the investor has the right, let's say I'm holding this convertible bond, I have the right to convert them into common shares within 5 years. Okay, anytime before 5 years, I can convert them into equity shares. And for every bond, I'll get 20 shares of common shares. I'll get 20 common shares for every bond I hold. Okay, if I don't convert it, what would I get? I'll get 60 rupees coupon payments, right? If I don't convert it, if I have the bond, then I'll get $60 coupon payment every year. But if I convert it, I'll not get this coupon payment. Now I have equity shares I'll start getting the dividends and the capital appreciation or depreciation. Yeah. So if you want to participate in the growth of the company, you have the option to convert them into common shares. So it's an attractive option, guys. Let's suppose you are holding the bond and you see that the company is doing really well. It's better to hold the equity so you can convert them into common shares. Okay, and because these would be attractive for the investors, the company can issue a lower coupon rate here because they are already attractive to the investors. So they can save some interest payments by offering a lower coupon. Are we clear on this?
Yes.
Then you have junk bonds. Junk bonds are those bonds which have a very poor credit rating. Okay. So, guys, do you know about rating agencies?
Yes, sir. S&P, Moody.
S&P,
Sir, CRISIL is the rating agency of India.
CRISIL in India, we have CRISIL. Few more, I don't remember, but yeah. So what do? They basically rate the companies, they rate the debt instruments of the company. Okay, these are credit rating agencies. So the issuer and the uh, credit instruments issued by the issuer. So let's say S&P Standard and Poor's rated a bond B or S&P has rated a bond or lower. What do we call that bond? A junk. Okay, and guys, how do they rate it? Any idea? How does any credit rating agency rate the bond? They look at the financial position of the company. They look at the cash flows, projected cash flows of the company. Does the company has enough cash flows to make the required coupon and principal repayments or not? Okay, if they have enough capability, they will rate them higher. If they have very poor capability, they will rate them very low. Okay, so junk bonds are those where the companies have a very low ability to make the required payments.
Sir,
Okay,
they also check for financial models of the company.
they build the models and based on that they project the cash flows and then they come to a conclusion about the rate. Yeah. So let's say they feel that a company has a high chance of default. Most probably they will not be able to make the coupon payments. In such a case, they will rate them lower. Okay, they will give a lower credit rating to those companies. In that case, we'll call them junk bonds. Okay, so there are high chances of default in these bonds. So there is a high risk, and also they will offer you higher returns.
Sir, can you suggest some credit ratings like it is double B, triple B, triple A? What are that?
Yeah, guys, every credit rating agency has a different rating system. Okay, for example, someone can have AAA as their best rating. Somebody would call AAA plus. Somebody may call double A. Called double A. so you have various ratings given by the rating agencies. Okay, and everybody would have a slightly different system. So you can check out for any rating agency. They sometimes change the uh, exact rating also based on the change in the financial position of the company. They can change the rating also depending upon their standard. As for S&P, it is AAA. That is the investment grade. The lower rating they have is AA, also investment grade. Then they have A. Then they have double B, E. Then they have C, C, then they have C. This, sorry. Is all the bonds which are getting a rating of this are junk bonds. Okay. Somebody who has defaulted, who has not made the payments, would be given a D grade. Are we clear, guys?
Yes, sir.
Hmm. Guys, let's take a break here. And meanwhile, You can revise what we have discussed. If you have any questions, we can take up the questions and then we'll go ahead. See you.
Hello, sir.
Okay, guys, let's continue. Please, everyone, come back. Okay, is everyone back? Can we continue, guys?
Yes, sir.
Yes,
All
sir.
right.
Yes.
Next, we have inflation index bonds. Okay, guys, can anybody tell me what is the inflation risk?
The inflation rate is higher than the coupon bond.
Sir, in which we get the more required rate of return than the inflation that is currently going on.
Guys, I'm asking what is the inflation risk? We studied about three risks earlier, right? What was the inflation risk?
Inflation rate is more than the interest rate.
For example, sir, there is a 9% coupon bond rate of the bond and the inflation is 10%. So there is an inflation risk of the bond.
Guys, when you explain inflation risk, you have to say that suppose we are holding a 6% coupon rate bond and it's a 5-year bond, and after we bought, inflation rises to above 6%. Okay, so that's the risk, that as the inflation rises, our real returns would become lower and lower. Okay, we would be stuck with this 6% bond if we don't sell it, and the value of bond would go down as the inflation increases. That's the inflation risk. Okay? Inflation risk. Now, what happens in inflation indexed bonds is that principal and coupon payments are readjusted based on the inflation index. Okay, so coupon payments would become higher and the principal repayment at the time of maturity would become higher to compensate for the inflation. Okay, so what would happen? The inflation risk which we were facing would be eliminated. Okay, so in the inflation indexed bonds, the principal and coupon payments are readjusted to eliminate the inflation risk. All right.
Sir, the principal amount is also readjusted.
Yes. For example, let's guys do one question. Okay, that will make it clear. It's a very simple bond I have taken, and it's a 2-year bond. Okay, and in the first year, let's say, second year, inflation is 6%. What would happen here is that in the first year, the principal amount would be readjusted. So the principal amount, not 1,000 anymore, it will become 1,000 into 1 plus inflation rate. So it would become 1,000. Yeah, and the coupon you will calculate on coupon will be 3% of. So guys, first of all, your principal component is readjusted. Now it is not 1,000 plus 1,030, and also your coupon payment will be readjusted. 3% of 1,030. That is 51,000. Guys, if I had asked you what would be the cash flows of this bond? What would have you have said? What would be the cash flows of this bond? Let's assume it's a normal bond without any inflation indexing. And the flows would have been this, right?
Yes, sir.
Yeah. But now what are your cash flows? At the end of first year, you are not getting 30, you are getting 31. Okay. And at the end of second year, what are you going to get? Can you try out the calculation for second year, guys, please? Based on similar lines. Please try, guys. Just like we did it for first year, can you try for second year? See, guys, your principal amount was already 1,050. Now, what is the inflation for second year? 6%, right? So your principal amount would be readjusted as per the inflation.
1060.
You get interest on that 1,092. So that will be is, if you look at it now, your cash flows. Rather than getting this, we actually got this. We got a higher coupon and higher principal repayment to compensate you for the inflation. Okay? So this means it would actually give you a 3% real return. 3% real return. Whereas till now we were talking about nominal return. But this is your inflation adjusted return or your real return.
Sir, what will happen in case of deflation?
See, it would not go lower. It would remain the same. Okay. In case of deflation, you would get these returns. Guys, is everyone clear, or you want to do one more question?
Clear, sir.
Clear? Next, we have perpetual bonds. So these are the bonds that have no maturity. Usually we have the maturity in case of all the bonds, but this is one exception where we don't have any maturity. They remain in existence forever. Okay? So anybody who buys a perpetual bond would keep on getting the coupon payments till infinity. Advantage for the investor is that they have a fixed income for lifetime. Yeah. Advantage for the issuer is that they don't have to pay the principal repayment. Okay. They don't have to pay the principal payment amount back to the investor. For example, guys, HDFC Bank issued 8.85 perpetual bonds in May 2007. Can you imagine, guys? Had we invested in those bonds, we would have got 8.85% return in lifetime. And considering the current rates, this is huge, right? And this is not too far back. So the people who would have invested in this bond would get 8.85% coupon. That means 88 rupees 50 paisa every year in their account from every bond they hold till lifetime.
Sir, this can be converted into equity share also.
No, no, no. This is a perpetual bond, which would be this would remain a bond. Okay, if it is a convertible also, then you can convert. Yeah. Next, you have deferred bonds, guys. Can anybody tell me what was a zero coupon bond?
There was no coupon rate. They were issued at discount and redeemed at par.
Very good. There was no coupon payment, right? Now, please relate that to deferred bonds. What do we have here? We have the payments deferred for some time. Okay. We have the coupon payments deferred for some time. So what do we mean by that is, let's say there is $1,000 face value bond 5 years, where the coupon payments will start after 2 years. Okay, so that means for the first 2 years you will not get any coupon payments. From the third year you will get the coupon payments. Okay, so this can look like this. It can also be the case that they make the deferred payments bigger. It can also be the case like this. It depends upon the conditions mentioned by the issuer in the bond indenture, whether they would be cumulatively paying the amount when they pay the coupons, or those coupons are gone. Yes, it can also be the case that they have mentioned that will not pay any coupon, but all the coupon payments will be made. Guys, is it clear? Can we go ahead?
Yes, sir.
Yes.
Then you have foreign currency bonds and you have euro bonds. See, let's say there is an Indian company who wants to raise funds in a foreign market. Okay, so they can issue foreign currency bonds to raise capital from the foreign market. Okay, for example, let's say Infosys issue give example of a foreign currency. For example, let's say Infosys thinks that okay, in the Germany market, we have a lot of demand. Okay, people know about our company, and we can raise funds from that market by issuing bonds. Okay, so what they will do, they will issue euro currency bonds. They will issue foreign currency bonds in euro currency. That means in the currency of that market, and raise money. Okay. So guys, this can be used if the other country has a lower interest rate. Let's say in India, if you issue the bonds, you have to give them 8-9% coupon. But in Germany, if you issue the bonds, you might just have to give 2-3% return to the investors. So it is less costly for you, and you can raise a lot of money because these markets would be more developed than the Indian markets. Okay, so you can raise funds in that market in their currency by issuing foreign currency. Yeah. All the payments the company is going to receive will be in euros, and all the payments, coupon payments and principal repayment they have to make would also be in euros. Are we clear, guys?
Yes, sir.
You have euro bonds, okay? So in that case, the market is different and the currency is different. For example, if Infosys issues bonds in the German market in USD currency, in euro bonds, the bonds are issued in market in currency other than that from the market.
So how they converted it into rupee if the issue is in USD currency in euro?
In the forex market, you can convert the currency.
Okay, sir. So there would be also costly if they convert into the forex market.
It will not be too costly. Whatever is the current exchange rate, you can do that at the current exchange rate. It would be advantageous for the company in case they have to offer a lower coupon. Slightly conversion charges will be taken by the broker, by the dealer, sorry, and that's all. But apart from that, if you look at it from the coupon perspective, there can be a lot of savings for Infosys. But guys, the catch here is that they should have their reputed name in the German market. Otherwise, nobody would buy their bonds. Okay, they should be popular. They should be trusted in the German market. Callable bonds versus putable bonds. Yes. Heard about these? callable bonds. So in case the issuer, okay, the issuer has the right to buy back all them. Guys, what can happen is, let's say there is a bond like this. Okay, it is a 5-year callable bond. Callable. So it's a 5-year bond, guys. It will mature in 5 years, but it can be called back by the company. The issuer can call them back or buy them back from the investor anytime in within 5 years at the rate of 100. Okay? So if they are issued at 1,000, then the issuer can call them back anytime at the rate of 1,000. Pay 1,020 anytime to the investor on and all back the bonds anytime. Is that all? Can anybody tell me, guys, why would a company buy back its bonds before 5 years?
Because of premium.
So they have to pay a premium, okay? If they don't call them back, if they let them mature for 5 years, they just have to pay 1,000 rupees. But if they call back before 5 years, they have to pay 1,000 in premium. So I'm asking, why would a company choose to do so?
The face value of the bond has increased.
See, guys, when let's say the company issued these bonds in 2020. Let's say the company issued these bonds in 2020. And in 2020, we saw that interest rates are just 3% now. Okay. They see that comparable bonds, new bonds are being issued in the market at just 3%. So why should we pay 6%, right?
Sir, can you repeat again?
I'm saying, let's say the company issued these bonds in 2020. Okay. After 2 years, they see that in the market, the rates have gone down to 3%. Okay. So in 2022, the bonds are being issued at just 3%. So what would they feel? Why are we paying 6%, right? Yeah, that's a costly for them. They can easily issue new bonds, get the required money, and just pay 3% coupon now, right? So they would not like to continue with the 6% bonds, right? So they would call them back. Got it? In putable bonds, guys, the lender, the investor, has the right to put them, sell them before maturity. they can sell them back to the company before maturity. Just the opposite of callable bonds. Here, company has the right to call them back. Here, investor has the right to put them back to the company. So let's say these bonds were issued at 6%, but now the interest rates are 9%. So obviously investor would not like these bonds. So he has the right to put them back to the company, get the required money and invest in new bonds which are offering 9%. So these are more attractive from the company's point of view. They give company the right, whereas these are more attractive from the investor point of view. They give the investor the right.
Sir, by the way, what are the most demanded bonds in today's market?
See, usually government bonds are in high demand and high credit rating corporate bonds are also in high demand. Okay, because they offer you decent returns, and so it's better than making a fixed deposit in the bank. You can easily buy government securities or corporate bonds of trustworthy companies.
Okay, sir.
Yes, can we go ahead?
Yes, sir.
Yes, sir.
that's about the variety of bonds, guys. So you can see there are so many different types of bonds, and that's why we say it's a very big market, because there are so many varieties. And even if you look at a simple bond like this, like this, okay, if I just make it this, it's a different bond. Okay? If I just do it like this, it's a different bond. Okay, so you can assume, you can imagine how many different bonds would be there. Okay, there can be a slight difference, and it would be considered as a different. So a company itself might have issued a lot of different types of bonds, yeah. Whereas in case of equity, there is just usually one equity for a company, right? So that's why the bond market is bigger than the equity.
Sir, what is the volume of bond market of 1 day transaction as compared to equity?
Yeah, that is huge. Okay, I mean, I think it is close to $90 trillion as compared to $70 trillion for equities.
Okay, sir.
All right. So next we have the coupon rate versus. So guys, can you tell me what is the coupon rate? What is the coupon rate, guys?
The interest rate at which we get capital gain in bond.
Yeah. So coupon rate is the rate at which, based on which the coupon calculation is done. Okay. So this is the rate which is mentioned in the bond indenture, based on which the investor gets the coupon payments. Yeah. This does not change. If it's a 5-year bond, this will not change for 5 years, right? This will remain the same. Whereas, guys, market interest rate is the interest rate which is prevailing in the market. Okay, this can change more frequently. This can change, let's say, every quarter. Yeah, as the new RBI policy comes in, as the interest rates are passed through from RBI to the banks, the interest rates, coupon rates being offered in the market would change, right? So market interest rate is something which is dynamic, which will keep on changing, whereas the coupon rate for a particular bond would be fixed. That will not change for the life of it. Are we clear with the difference?
Yes, sir.
Yes, sir.
Okay, so let's suppose that coupon rate, currently, let's suppose the market interest rate is 8%. Okay. Now, if some company wants to raise funds 5 years, I bonds, they can do that, right? Now, let's say the company issues 7%. 7% coupon rate. What do you think? It's a $1,000 face value bond, 7% coupon rate bond. It will be well received in the market or not?
is lower than the market rate, but similar to that.
Absolutely, absolutely. Okay, so the point here is market interest rate is currently 8%, right? But the company is willing to just pay 7% coupon rate. So such a bonds will not have a huge interest in the market. Such bonds will not see a lot of demand for such bonds, right? So the demand would be lower than the bonds the company wants to issue. Okay, so in such case, when the demand is lower, they will be issued at a discount. Okay, so they can be issued at, let's say, $950. Why not $1,000? Because these are not attractive bonds and the people are not ready to pay $1,000. The company is not offering the interest rates, the coupon rates which are prevailing in the market. They are offering a lower coupon rate, so there will be lesser demand for such bonds. So lower the demand, lower will be the value or the price of the bonds. So these will be issued at a discount. Okay? So when the coupon rate is lower than the market interest rate, such bonds will be issued at a discount. So let's say the face value is $1,000, they will be issued at less than the $1,000. Yeah. Similarly, guys, if coupon rate offered by the bond is greater than the market interest rates, such bonds would be issued at a premium. Let's say 1100. Whereas in the above case, it would be something like 9. Okay, we are talking about $1,000 face value. Okay. Whereas if you look at the bonds which are issued at just the market interest rates, exactly they are offering what is happening in the market. They will be issued at a par, that is. Guys, are we clear? Can we go ahead?
Yes.
Now, guys, let's say there is a bond, there is a $1,000 face value bond. Is offering you 8% coupon. It has a 3-year maturity. It is trading at $950. Now, guys, if you buy this bond, okay, if you buy this bond, how much do you have to pay?
1000.
950.
You have to pay 950. Okay, please see carefully, guys. How can you say 1000? I've written trading at 950.
Sir, but the issuer is issued at 1000, so but the trading is at 950, so we buy at 1000.
Where did I say the issuer has issued it at 1000?
Because
If you buy the bond, how much do you need to pay? You need to pay 950. Okay, I never said that the bond issuer has issued it at 1000. Okay, so if I
yes,
buy the bond right now, I have to pay 950. And what is the amount I'm going to get?
80.
Are we clear on this? Now, guys, can you tell me you are getting the returns in which form? One is your coupon, yeah, and the other is capital appreciation. Okay, you are getting coupons of 80, right? And what is the capital appreciation? You invested 950 and you are going to get 1000. So 50 would be a capital appreciation. Am I right? Sorry. Is it clear, guys? So when you invest in bonds, you get returns in the form of coupon payments. Get returns in the form of coupon payments and capital appreciation or depreciation. Can be depreciation also, guys. Can you tell me when it would be depreciation? Suppose the bond is trading at 1100. Okay. So if you buy it now, you have to pay 1100. And this is what you are doing, right? So in this case, you will say there is a capital depreciation. You pay 1100, but you only get 1000 at that, right? So there is a capital depreciation. Okay, so you will have two forms. You will have returns in the form of coupon payments and capital appreciation or depreciation. Okay, so guys, there is a concept of current yield. Current yield is like the returns you are going to get in the form of coupon payments only if you invest at the current market price. That's the current yield, guys. So if I ask you what would be the current yield in this bond, can you tell me?
80.
No. So in this case, your current yield would be 80 upon 90. So can you calculate this, please?
8.4.
So guys, 8.4% annual return you are getting in the form of coupon. Because you did not invest 1,000, okay, you invest only 950, and you are getting a return of 80 by investing 950. So it's like a 8.4% return in the form of coupon, right? Are we clear on this? Let me know, guys. Are we clear on this?
Yes, sir. I write, sir.
Okay. Guys, then you have the yield to maturity. As an investor, what do you want? You want the current yield to be higher or no?
Yes, sir. I.
Yeah, you would like it to be as high as the lower you invest, the more you get is all you want, right? So when you are investing in the bonds, you can look at the current yield, and higher the current yield, more attractive the bond is, right? But guys, it only measures the returns in the form of coupon payments, not the capital appreciation. Then you have yield to maturity, which gives you the annual returns you would get in the form of coupon payments and capital appreciation or depreciation. If you invest in the bond, if you invest in the bond at the current market price, and there are two assumptions, guys. So there are two assumptions, guys. Let's say we are talking about this bond. So you should hold it for 3 years. Okay, you should not sell it in between. Second assumption is that whatever interim cash flows you are getting, like 80 and 80 here, you should reinvest them at the rate of Y. You should not leave them as it is in your pocket. You need to reinvest them at the rate of YTM. Then the return you would get is known as the Y. Okay, so YTM is the annual return you would get in the form of both the coupon payments as well as capital appreciation and depreciation, given that you hold the bond till maturity and interim cash flows are invested at that. Okay.
So the annual coupon rate we invest in this. We get
Yes, whatever interim cash flows are there, whatever interim coupons you are getting, should keep on reinvesting.
okay. Sir.
Okay. So guys, earlier current yield was there, which was only measuring the returns in the form of coupon payments. But how is YTM different from a current yield? It measures the returns in the form of both coupon payment and capital acquisition. Okay, it considers both these things, whereas current yield considers only the coupons. Are we clear on the difference, guys?
Sir.
Can you repeat again?
See, there are two forms of returns when you invest in bonds, right? Current yield only considers the coupon payments, yeah, whereas YTM considers both of these forms of payments.
Get it.
So what about the remaining cash equity section?
Yeah, we will do it. Don't worry. Okay, we'll do it. Let's complete this topic today, and tomorrow, first thing we'll do. One more concept, guys, of accrued income that we have the three price and the price. Now, let's take an example to understand this, guys. Uh, let's say there is this bond. Please read these two lines. What do we understand by this, guys? Let's suppose somebody bought the bond on 1st January. Person is selling the bond on 30th. Okay. So for 4 months, that person held the bond, right? What is the annual coupon on the bond? $60, right? That is for 12 months. Yeah. The person held the bond for 4 months. So do you think he deserves it? When will the coupon payment be made? At the end of the year, right? So on 31st December, the coupon payment would be made of $60. But he sold the bond on 30th April. So only after 4 months he sold the bond. So would he get any coupon payment?
No, sir.
No, right? But he deserves to get the 4 months coupon?
Yes.
Yes.
Yeah, because he was the investor, he was the holder of the bond for 4 months. So whatever it should be the coupon for 4 months, let's say $20. $20 is the accrued interest. Okay. This is the concept of accrued interest, that coupon payment or that interest which has been accrued but not yet paid. Okay, which is due but not yet paid. Okay, the payment would happen after 12 months. So in 4 months, this much payment is due, but it is not yet paid, right? That is accrued interest. Okay. Now somebody who held the bond for these 4 months deserves to get $20, right? So guys, clean price is the price which does not include the, let's suppose guys, on 30th April, 2021, bond is trading at $1,010. Okay? So the clean price would be this $1,005, and it does not include the, whereas the dirty price is the price of the bond, which includes the accrued interest. So 1,005 plus $20. That would be 1,000. Okay, so this is the price which includes the accrued. Okay, 30th April, the clean price would be this and the dirty price would be Guys, are we clear on this?
Yes. Sir, by the way, clean price and dirty price are basically on which type of bond basically it is?
Yeah. What are you asking?
Sir, clean price and dirty price, if we sell, so which type of bond it will be applicable?
No. If it be applicable for all the bonds, the seller of the bond would get the dirty price. The buyer of the bond has to pay the dirty price to the seller.
Yes, sir.
See, guys, there are various day count conventions. Okay. For example, there can be, we call them day count conventions. See, it can be actual upon 360, it can be actual upon 365, it can be actual upon actual, or it can be 30 by 360. We are doing the calculations. You need to be aware about the day count convention being followed in that market. Okay. For example, if it is actual upon 360, how will you calculate the interest? Okay, this will be, in such a case you will do 60 upon, sorry, $60 to, what is the actual days? 31. Guys, how many days are there in between? In January we have 31 days. Let's say we have 28 days. March we have 31. For April we have 8. So what is the actual number of days?
20.
120, sir.
120. Guys, what you will do here is 120 upon 360. Guys, what you will do here is 120 upon 365. What you will do here is 120 upon 365. You will consider every month to be of 30. So there are 4 months, so 120 again upon 360. So guys, how you calculate the accrued interest would depend upon the day count conversion. Are we clear on the calculation part, guys, and the conceptual part? Please note it down. If you have any questions, let me know.
So can you please explain day count conventions again?
Sorry?
So can you please explain again the day count conventions?
Okay. How you would calculate the exact accrued interest for a period, that would depend upon the day count convention. Okay. For example, the person bought the bond on 1st Jan and sold it on 30th April. Okay. So there are 120 days in between. Now, exactly how do you calculate the accrued interest? We know that for the year it is 60. So for 120 days, it should be how much? Okay. Now that would depend upon the day count convention we are following. It can be actual upon 360. Actual is 120 upon 360. Okay. Or it can be actual upon 365. So that would be 120 upon 365. It can be actual upon actual. So that would be 120 upon 365. It can be 30 by 360, where every month is considered to be of 30 days. So there are 4 months, so that will be 120 upon 360. Okay, this is just for the calculation part of accrued interest, and this would make a slight minute difference. That's it. Okay, guys, noted.
Yes, sir.
Next, guys, we have the concept of mortgage-backed securities. Okay, so that's all about the bonds. Now we are going to talk about mortgage-backed securities. Guys, any idea about this? What are mortgage-backed securities?
Securities or home loans that are backed by the properties of people.
Securities that are backed by mortgages.
Mortgage.
And what is a mortgage? It's a home loan.
Home loan.
So guys, exactly as the name suggests, securities which are backed by mortgages. And what are the mortgages? Home loans. Okay. So what happens is,
Sir, mortgage would be anything. Na? Only the home loan part is mortgage.
yes. Okay, it's related to the property only mortgage. Okay. So guys, what happens is, let's say there is John who wants to take a home loan, buy a house, and he wants to take a home loan. So what he does, he goes to the HDFC bank to ask for the home loan. Now there would be so many people who would be asking for home loans from HDFC bank, right? So all these home loans would be collected as a pool of assets. Okay. These these home loans would be shown as assets on the balance sheet of HDFC Bank. Guys, do we know what are assets? Do you know what are assets and liabilities, guys?
Yes, sir.
Yes.
Assets is something which is going to give us benefits, right? Now, because you have given the home loan to somebody, he is going to pay you the EMIs, right? He is going to pay you the EMIs for next 10-20 years. Yeah. So you are getting benefit from that. So that's why you call it a asset. Okay. So on the balance sheet of HDFC Bank, they will be shown as an asset. What HDFC Bank can do is sell these home loans assets to an IB investment. Okay. And what would investment bank do is it can issue securities against those assets of which are basically the home loans. Yeah. And these securities would be known as the mortgage backs. Okay. So these would be issued to the investors who want to invest in mortgage backed securities. Okay. Just to repeat, guys, there are a lot of people who will be taking loans from a retail bank, let's say. Yeah. What retail bank do? It will collect all the pool of those home loans and sell those assets to the IB. Okay. IB will be the owner of those assets. So the EMIs will flow from HDFC Bank to the IB. Okay. And in return, IB would give the money to the HDFC Bank. When they are selling the assets to the IB, they get all the money upfront from IB. Okay. Now slowly all the EMIs will be coming in and they will be flowing through from HDFC Bank to the IB. Because IB is the owner of these home loan assets, so EMIs should go to the IB. Okay. What IB has done, they have further issued securities against these home loans and got the money from the investors of MBS. Okay, so first of all, HDFC Bank got the money from investment bank, then investment bank got the money from the investors by issuing MBS to them. Now, as the money flows from John to the HDFC Bank to the investment bank to the investors of mortgage-backed securities. Okay.
Sir,
And
can you repeat once?
but what is the doubt?
Sir, the between HDFC Bank and investment bank.
Yeah, so what happens is HDFC Bank has collected all these assets, yeah, and they are going to get EMIs for next 10-12 years. Yeah, they don't want to wait for 10-12 years. So what they do, they collect all these assets and sell all these assets to IB. And in return, IB would pay them for these assets. Yeah, now EMIs belong to the IB. Okay, what IB would do is issue securities against those assets to the investors. Those securities are known as mortgage-backed securities. Okay, so as the IB would get the EMI money from the investors, from the borrowers, it would flow it them through to the MBS investors. Are you guys?
Okay, sir.
Guys, are we clear on this? Guys, this entire process of issuing securities against the assets is known as securitization. This is known as securitization. Okay, so these are like financially engineered products by the investment banks. MBS is an example of that. Financially engineered product by the investment bank. And guys, if you would have heard about 2007, 2008 financial crisis, it was on similar lines. Okay, so collateral debt obligations were issued by the investment banks to the investors, and later on, when the borrowers defaulted, the entire chain got impacted. Okay, so when we cover derivative swaps topic, then we'll discuss about credit default swaps. Okay, those were the major culprits of 2008 financial crisis. Okay, so once we understand the credit default swaps, I'll also explain you about what happened in 2008. Okay, why did the crisis happen? Right now, it will be difficult to understand as we don't know what is a CDS. Are we clear on this, guys?
Yes.
Next, you have the asset-backed securities. Okay, these are very similar to mortgage-backed securities, just that there is a more broader term, more general term. So any securities which are backed by assets such as personal loans or credit card receivables, education loans, vehicle loans, etc. Okay, so apart from home loans, you can talk about personal loans, vehicle loans, education loans, credit card receivables. These kinds of assets, when the securities are backed by these kind of assets, we call them ABS. Assets are specifically the home loans, we call them NBs. Okay. Okay, guys, I'll take your attendance. Ashutosh,
Present, sir.
Mansi,
Present, sir.
Moksh,
Present, sir.
Parichay,
Present, sir.
Yogita,
Present, sir.
Anushka,
Present, sir.
Paridhi,
Present, sir.
Diksha,
Present, sir.
Rudraksh,
Present, sir.
Razwal,
Present, sir.
Nasreen,
Present, sir.
Zeenat, Zeenat.
Present, sir.
All right, guys. So quickly go through what we have discussed today in the fixed income securities. If you have any doubt in any topic, let me know. We can discuss that further.
So ABS, asset-based security, backed security.
Nothing much to say in that. These are just again the financially engineered products. Okay. So why do we call them asset backed? Because these are being backed by a particular asset. Okay. The money is going to flow from that asset, and that money would be paid to the ABS investors. Okay. Now, what are those assets? Those could be personal loans taken by somebody. So you collect all such loans and issue securities against those assets. Okay. It can be car loans, it can be education loans, it can be credit card receivables. So basically, the idea is you collect all these all these loans from different people, and that would become a big asset. Now that asset is going to give you money. Yeah. So what do? You issue securities against these assets. So those securities are backed by these assets. As and when the money is going to come from these assets, that money would be passed through to the ABS investors.
Sir,
Yeah.
inflation index bonds.
Inflation index bonds. Okay. So the idea behind the inflation index bonds is to kill the inflation risk. Okay. What is the inflation risk? That inflation is going to eat our returns. Yeah. Because of inflation, we'll not get the returns in the real sense. Yeah. So what do inflation index bonds do? They compensate you for the inflation. Okay. So whatever is the inflation, the principal amount would increase by that. And the coupon would be calculated on that increased principal amount. Okay. So that means you would be compensated for the inflation by getting a higher principal and the coupon payment.
Sir, who issues these inflation index bond?
Anybody can issue, government can issue. See, the
Okay.
government usually issues the government bonds, okay? Corporates can issue inflation index bonds, but there is no restriction on anybody. Anybody can issue them, but usually they are not issued that much, okay? These are not that popular instruments because there is always an uncertainty in terms of inflation. So nobody knows how much they would eventually need to pay. Okay. For example, a company issues the inflation index bond, they don't know exactly what they need to pay, right? What would be the inflation? So it brings an uncertainty to the issuer also, which the issuer will not like. They would rather like a bond in which they know that they have to pay just 8% coupon. That means 80 rupees. That's fine. They have a certainty. They can plan the cash flows, right?
Sir, interest rate risk, can you explain?
Interest rate risk is the risk that once you have bought the bond, the interest rates might rise. Okay. But you would be stuck with a bond which is offering you a lower coupon rate, right? So in that case, the value of your bond will go down. That's the interest rate risk.
So government bonds are generally unsecured bonds, right? In the safest
Government
form.
bonds are always unsecured bonds, but still they are considered to be safe because government has the authority to print money. So we don't expect them to default. All right, guys. So I hope you got some idea about the two capital market products, equities and bonds, right? See, guys, on level 1, we'll be focusing on the products. Okay, so we should understand what are the different products which an investment banks usually deal into. Okay, so these are some of the common products, guys. And once we have understood the products, then we'll look at the processes followed in the investment. That would be level. Okay, any other question, guys? All right, guys. Thank you so much. I'll see you tomorrow. Please keep
Thank
it
you.
what we are discussing. Okay. Please find
Sir,
some time to for your revision. Yeah.
cash equity is
Thank you, sir.
incomplete.
Sorry, cash equity is remaining part, right?
Cash equity is incomplete.
Incomplete. Yeah, one that topic. Okay, we'll start with that tomorrow. Okay, first we'll do that, then we'll start a new topic.
Okay.
Okay, just remind me
Thank you, sir.
tomorrow morning. Okay, please. Thank you. Thank you,
Thank you.
guys. Bye bye.
Thank you, sir.
Thank you, sir.